All right, we're going to start, we're going to continue chapter 11 on liability. We just have a little bit of bonds payable, the very last situation, premium on bonds payable to review again. I briefly went over this last Wednesday at the end of the class. Okay, so let's just take a look at the bonds payable at a premium case. There's a couple of journal entries, and again, always the first one is when we issue the bond. If the price is different, if the issue price is different from what the price is listed on the bond certificate, how do we journalize these cases? And remember, we talked about bonds in 3 different cases. Because of the interest rate differences, we may have companies may be issuing bond at the face value or at a discount or at a premium. Okay, so premium is the last case that we've talked about here. And this example given to you is assuming that the face value of the bond is $100,000, assuming that this is the capital that the company wants to borrow from the creditor. And if the stated interest rate is different from the market's interest rate, then what happens is when the company issues the bond in this case, if market's anticipating a rate slightly lower than what the company is offering, then relatively speaking, companies' bonds will be at an advantage. Okay, so they will be raising the capital at the dollar amount above the face value. So in this case, in the example, we assume that the bond's price is issued at 1.041. So it could be any price as long as it's above 1. It's considered issuing bond at a premium. Right, so this journal entry here, the debit side cash, we have the bond's face value times the price. So again, don't forget that bond's price oftentimes is listed as quoted percentage of the face value. Remember, in a discount case, it could be issued at a price 95 or 98, and at a price lower than 100%. So in the case of a premium, it will be at a dollar amount above 100%. Okay, so this example here, we have premium dollar amount. So what is the premium amount here? Face value is $100,000. Premium would be how much? Just $4,100, right? So this $4,100, just like discount, we would take care of it later on. We will have to amortize it every half a year. So remember that discount, in the case we consider discount, when we issue bond at a discount, it's additional interest expense that we're giving to creditors. Now here, premium is the opposite of discount. We think of this as an interest reserve. So we collect, basically, later on we will still be paying cash interest, but since we're getting a premium while we issue the bond, relatively speaking, the interest that we're giving away to creditor is not as high in this case compared to issuing at a face value at par. Okay, so the company had $100,000 in mind, but at the time when they issue the bond, they're collecting, in reality, $4,100 more than the face value. So when we journalize this entry, this affects bonds payable account. Again, we're borrowing money at the face value of $100,000, but we're also borrowing $4,100 at the time of issuance. This is the part above face value, premium. Okay. So just to refresh your memory, the reason why we have 3 cases is because interest rates are different. Sometimes when companies issue the bond, they borrow money. The market interest rate is different from the company's stated interest rate. So if it's the same, the market is anticipating, let's say, 9% of interest, company is offering 9%, then basically they'll be issuing the bond just at $100,000. Okay, now in the case of discount, that would be the case if market is anticipating an interest rate higher than what the company is offering. So in that case, company's bond is at a disadvantage compared to other companies. When creditors borrow money to the company, they'll be borrowing less than the face value. Now this case here is the opposite of discount. This case here is market interest rate, for example, is 9%. The company is offering, for example, 10% of interest or 11%. So at the time of issuance, the company will be collecting more than the face value, not just $100,000. And the difference is what we call premium on bonds payable. Okay, but don't forget that later on when the bond matures, company is always paying back to creditor the face value, the maturity value of the bond, which again is still $100,000. Okay, so because of this, while we issue it, we're collecting more money. At the end, regardless of whichever case we're still paying back, company is paying back $100,000 to creditor, we will have to do something about this $4,100. 104.1, that is given to you. So 104.1 is like the quoted percentage of the face value. So if it's 100, that means 100% of face value. If it's 104, that means 104.1% of $100,000. So that's why we times 1.041 to the $100,000. So think of it as percentage. Okay? It's sort of like savings, yes. In the beginning, when they issue the bond, it would look like, so again, this bond has a lifetime. At the time point when they issue it, it will be at this dollar amount, right? Originally, the bond certificate has this amount, but they're collecting this amount at the time of issuance. At the end, when they're paying back the money, they're still paying back $100,000. Okay, so throughout the period of time, this premium dollar amount, we would again amortize it every half a year, little by little with the interest entry. But this is not considered additional interest. This is like you collected money up front, so later on when you pay back interest, it relatively seems less. Okay, so if we take a look at the interest entry, again, this part here, premium on bonds payable, has the same credit balance because you're borrowing more money from creditor. Later on, shown on balance sheet here, it looks like this. Okay, bonds payable is still at the face value. So regardless of whichever case, bonds payable, the original face value is still there, but there will be a discount listed beneath it or a premium listed underneath it. Okay, so the carrying amount here, like the face, basically looks like the book value of the bond is $104,100. This is the carrying amount, and then we have to amortize this $4,100 of premium later. Okay, now don't forget that interest for bonds is paid every half a year. Now the formula to pay interest, the cash interest part, is exactly the same for all three cases. We're always calculating cash interest part based on $100,000 face value times interest rate times half a year. Okay, so this part, cash interest payment, $4,500, is the same for issuing at par, same for issuing at discount, issuing at a premium. Okay, but later on when we journalize the interest entry, if it's at par, basically interest expense would equal cash interest that we're paying. If it's at discount, interest expense would equal cash plus a portion of discount on bonds payable. If it's at premium, then later on this $4,500 would not be the same as interest expense either, but interest expense will be lower than cash interest. Because earlier when we issued the bond, we collected more upfront. So relatively speaking, what's into interest expense account, later on we recognize it as lower than $4,500. Okay, we'll be showing the interest entry in the following slide. Okay, so when we journalize interest here, again, cash interest, we're always paying $4,500. This is always calculated based on the principal amount of the bond, interest rate, half a year. The difference is that here, this is not equal to interest expense because we amortize premium in the middle. Okay, keep in mind, premium is additional money that company is able to borrow from creditor at the time point when they issue the bond. So even though later on they're paying interest $4,500, since in the beginning you collected more money, you can think of it as really recording interest expense. We're really giving away interest, not as much as $4,500 because we collected $4,100 in advance at the time of issuance. Okay, so when we journalize interest entry, premium on bonds payable, we amortize again based on the lifetime, 5 years. And then since we're journalizing this every half a year, we will be reducing the premium account 410 every half a year. Okay, so the premium on bonds payable account earlier, there was $4,100 of credit balance. After this journal entry, we deduct $410,000. This is half a year. And then another half a year, you deduct another $410. Another half a year, you deduct another $410. So after 10 entries later, this premium on bonds payable becomes 0, and that's the time point when bonds payable matures. The $100,000 will need to be paid back to creditor. Okay, so 5 years later, after 10 journal entries of interest, what would be the last entry to do when we want to pay back this money to creditor? When company is paying this money to creditor, what do we journalize at the end?
Flip the first one.
Just flip the first, is it just flip the first one?
The first journal entry. Last one.
So that would be, so what about the premium here? First entry, there's a premium. So premium will gradually be reduced little by little every half a year, right? So when it reaches the end of the bond's lifetime, we're basically just paying the face value, the par value of the bond, right? So for all 3 cases, when it reaches the end of the year, discount and premium disappears when we're paying back the money to bondholders. Okay, very last entry would always look like this, regardless of whether you issue the bond at the par value, at discount, at premiums. At the end, it always looks like this. Okay, because in the middle of the year, we already took care of all the interest, and also we amortized all the premium and discount little by little every half a year. So the third entry for all 3 cases is the same. You're paying back just the face value because you already deducted and amortized all the discounts and premium in the middle. Okay, now for bonds, all 3 cases, the critical entry really is the interest entry. If companies issue the bond at the par value and maturity value, meaning the stated interest rate is the same as market interest rate, then every half a year when they journalize interest expense would be the same as the cash interest that they're paying, $4,500. Okay, because in the beginning there wasn't any discounts and premiums. They had $100,000 of bond certificate in mind. They want to borrow this amount of money, and they actually did borrow that amount of money. So when we calculate interest, it would just simply be $100,000 times 9% times every half a year. $4,500 would be the cash interest that the company is paying, also the interest expense recorded. But for discounts, remember, discounts on bonds payable, this is a contra liability account. Oftentimes when we just issue the bond, there's a dollar amount here, and then we gradually reduce little by little every half a year in interest entry. So in that case, any discount on bonds payable when we journalize interest, we're paying cash interest still $4,500, but there will be a discount on bonds payable that's additional interest expense considered. Because in the beginning when we issue bond, we collected less money from bondholders, and we think of it as additional interest that we gave to bondholders. And that part we gradually consider it into interest expense. So then interest expense, there are two parts, discounts and cash interest. For bonds payable at a premium, it's the opposite compared to discounts cases. So premium, we basically borrow more money at the time point when we issue bonds because our interest rate is more attractive compared to other companies' bonds. Okay, so when we borrow more money up front, later on when we consider interest, even though we're paying $4,500, we think of that additional money as reducing interest expense actually recognized. Okay, so we don't have $4,500 here, but we have a lower amount here as interest expense because this part here, premium, we collected more money than we thought we could. So think of this as reducing interest expense. That's what's happening here. So every half a year we will journalize the same entry that looks like this for 10 times. And then at the end, when the bond matures, it will be this entry, pay back the original face value. Any questions? Okay, let's do an exercise on premium. Now take a look at this case. Assuming that company wants to issue a bond at $50,000. This is the face value, the maturity value of the bond. It has a stated interest rate of 5%. And this tells you that the bond's lifetime is 10 years. Okay, so meaning that if we journalize entry for interest, there will be 20 times, 20 journal entries of interest. Every half a year we journalize it one time. The price of the bond at issuance is 108. So what does 108 mean? It's a quota percentage of the price. So if we want to figure out the issue price, that would be face value times 1.08, right? Because 108 is the quota price of the quota percentage of the bond's face value. So if you have the issue price there, try to figure out the premium amount. See if you can journalize the first entry, issuance on bonds payable. Second, if we want to pay interest every half a year, how do you journalize this? A 1.08. If you times 1, that basically is the same, right? So if it's a premium, you have to times, it's a percentage. Okay? I just passed around a couple of weeks of practice questions, so if you came a little bit later, make sure to pick it up. I think it's at the back. Okay. Okay, first journal entry here, what do we debit and credit in issuance entry? Where bonds payable will be credited because we're borrowing money and we're definitely getting cash, and is that it? Is it a discount or is it a premium? There's definitely something in the middle, but which one? It should be premium because the price is above 100% of the face value. Okay, so as long as the price is above 100, it's considered a premium because remember that's a percentage. If it's 100, that basically means we're issuing at par in maturity value. That means just 100% of the face value. If it's 108, that means 108% of the face value. So you times 1.08 by the face value of the bond. So there's a premium here on bonds payable, and don't forget premium is an adjunct account. It's not a contra liability account, so it has the same direction as bonds payable. Okay, because basically that means we're borrowing we're borrowing more money compared to the face value of the bond. So face value is $50,000. What is the dollar amount of premium? Well, the price is $50,000 times 1.08. That will give you $54,000. So yes, $54,000 is the cash that we're getting. So the differences will be the premium, $4,000. Okay, so issuance entry will look like this. If we put this into T accounts, you will have bonds payable, $50,000, right-hand side. Premium on bonds payable also, $4,000, credit side. Okay, both dollar amount is the money that we are borrowing at the time when we issue the bond. Okay, again, the reason why it's above face value is because Well, this problem didn't tell you what's the market interest rate, but if there were a market interest rate listed, it definitely is a percentage less than 5%, meaning the company's bonds interest rate is more attractive. Okay, so $54,000 is the dollar amount they're getting at the time of issuance. Premium is $4,000. And remember, we have to do something about this because this we consider as additional money we collect from creditor, from bondholder. Later on, even though we're paying cash interest every half a year, the same as what we paid for discount case, for par case, but this basically reduces interest expense. Okay, so next entry for semi-annual interest. First of all, how do we calculate cash interest? We use the face value, always the face value of the bond, times interest rate is 5%, right? Given to you in the problem, and then times 6/12. So this part here is cash interest that we're paying every half a year. In terms of what is interest, that would be cash interest minus this premium amortized every half a year. Okay, so that'll be 4,000 divided by the lifetime of the bond is 10 years. And since we're doing this every half a year, so that calculation formula is this. Okay, so cash interest part, you see, this is what I wrote here, $50,000 times 5% times half a year. That'll give you $1,250. This is the cash part that we're paying. But it does not equal interest expense because there's premium that we issued in the beginning. So this premium, we think of it as reducing interest expense actually recognized for that year. Okay, so the same as discounts, premium, we slice it into basically the lifetime of the bond. Every half a year, we'll be reducing premium account by $200. And we'll be doing this for 20 times. Okay, so cash interest part will be $1,250. Premium on bonds payable $200. After subtracting $200, what's actually considered an interest expense would be $1,050 every half a year. Okay, so the carrying amount of bond, in the beginning when we issued the bond, the carrying amount would just be basically the dollar amount that we got from bondholder, $54,000. But gradually we'll be reducing the carrying amount because we're reducing $200 every half a year. So the carrying amount will be reduced by $200 every half a year. When it reaches 10 years later, when the bond matures, the carrying amount of the bond would just be $50,000, and then this is also the time when we pay back this $50,000 to creditors. So this works opposite compared to discount case. Discount in the beginning, the carrying amount of the bond will be at a dollar amount lower than face value, and then we gradually increase the carrying amount for a discount case. But for premium, since we're able to borrow more money in the beginning, we gradually reduce this premium considered as interest expense deduction account. Any questions to this? Okay, if I add another question, the third entry, when the bond matures, how do we journalize this? Basically, bonds payable will be reducing that, and what else? Cash by $50,000. Very good, just the face value. So this is the last entry when the bond matures, would always look like this. Okay, for bond, all these three cases is very important. First case, issuance at a par and maturity value at face value is easier compared to discount and premium, because in the beginning, we're basically just collecting $50,000, and then we're paying interest based on 50,000 times 5% times every half a year. Cash interest equals to interest expense. That's for the first case, issuance at par. Issuance as discount is the opposite case compared to this one. Basically, we're getting less money than the face value in the beginning. So that money, the portion that we did not get, different from face value, is the part that we consider discount, and that's additional interest that we gave to creditors in terms of borrowing the money. Okay, so in that case, interest expense would be cash interest plus discount. That would be interest expense for a discount case. Now for premium, since we're getting more money in the beginning, this is the part that we did not expect, but we got additional from creditors. We basically consider it every half a year's interest expense not equal to cash interest, but at a dollar amount lower than cash interest. Because this part here, we gradually spread it along the years. Okay, so it's very important to understand all three cases. How do you journalize the three entry? Issuance entry, interest entry. Later on, when company paid back the money, how do you journalize all three entries for all three cases? And also carrying amount of bond. Understand how carrying amount changes. Carrying amount is like the book value of bond. In the beginning, book value is $54,000. After half a year, book value basically is $54,000 minus 200. Okay, after another half a year, you minus another 200 because this part gradually reduces. The reason why we're doing this is because at the end, we're just paying back the face value. Keep in mind this part is very important. Since we're only paying back face value, we have to do something about this premium account or discounts. And this often happens because market interest rate may not be the same as the stated interest rate the company is offering. So oftentimes, market interest rate will be changing on a daily basis. And when company issues bond, there will be cases of discount, there will be cases of premium. And we amortize it every half a year. So later on, when we pay back the bond, we're just paying the face value. Okay, are we good to move on? Kind of. Okay, the last case here for interest, there's a special case if, so far what we talked about is issuing bond in the beginning of the year, paying interest in the middle, and at the end of the year. Now sometimes companies may be borrowing money in the middle of the year. So when this happens, when it reaches the end of the year, oftentimes again, companies will be issuing financial statements, so they have to update the account. So earlier, all three cases, we assumed that the issuance starts January 1st, interest is paid off either July 1st or June 30th, and then the second half of the interest paid December 31st. So there wasn't any cases of adjustments to be made. So this is an example if the issuance doesn't happen just on January 1st, it's on whatever date that is in the middle of the year. And when it reaches the end of the year, we don't have to pay money to creditors yet, to bondholders yet, because it hasn't reached half a year. But we still have to journalize an adjusting entry to recognize the interest at year end. Okay, so this is very similar to short-term notes, long-term notes. When it reaches year end, if it's not the due date, if we're not obligated to pay money yet, we have to just adjust the interest expense, interest payable entry. This part is exactly the same as that. Okay, so assuming that the first entry here, assuming we issued a bond October 1st, and what happens in this first entry is when it reaches December 31st, we want to recognize interest expense for just 3 months. Because we issued it October, so we have a whole October, November, December. But remember, we only pay interest to bondholders every half a year. So if we issue the bond October 1st, we're not paying the half a year interest until the following year, March 31st. But when it reaches this year end, we have to accrue the entry that has been accumulated on the bond because we want to issue financial statements. So we want to update the accounts. Okay, so this journal entry is what we're trying to do here, accumulating interest on the bond that was issued in the middle of the year, not in the beginning. So here you see that interest expense, interest payable, discount on bonds payable, you don't see cash here because we're not paying cash yet. We're paying in next year when it reaches half a year later. So we have interest payable here calculated by the face value, still $100,000, times the interest rate, 8%, and then for 3 months only. Okay, so this is the interest that we owe to bondholders, but since it's not the pay date yet, it's just considered payable, not cash. You know, always at the time when we adjust any part of the interest, we also take care of discount on bonds payable. So this case here, we only amortize discount on bonds payable for 3 months, for $50 only. So earlier the cases were just assuming that we're paying off the interest at year end, and it coincidentally is just the time point for financial statements and the time point for the pay date for the bonds. So at that time we will just credit cash, credit discount on bonds payable for 6 months. This is a case that we only accrue interest for 3 months, and it's not the pay date yet, so it's considered payable, interest payable for 3 months. So what's the thing about payable? What happens to payable later on when we want to pay it? The reason why it's called payable is because it's a liability, and later on we need to pay it off by cash, right? So this part, interest payable, the 3 months here, will be paid off when it comes to the pay date for bonds interest, which is another 3 months later, because we only pay interest every half a year. So when it reaches March 31st, that interest payable $2,000 will be reduced, and we're also paying an additional 3 months of interest for January, February, and March. Altogether, 6 months of interest we're paying on the pay date, March 31st. Okay, we're basically just reversing that interest payable. We're reducing it because now when it comes to the pay date, we're actually paying it by cash, 6 months. And then since we consider 3 months of discount on bonds payable last year end, we only have an additional 3 months of discount on bonds payable to consider here. Okay, any questions? Now, if I change this problem to the issuance date is November 1st, what part would change here? Or how would we calculate the dollar amount for interest payable or discounts? We'll be switching the months to, for the first entry, which part will we change? It will still be face value $100,000, still be interest rate 8%, but only for 2 months because we only have November, whole November and December. Okay, so we're doing 2 months of interest accumulation. We still have interest payable account, interest expense, discount on bonds payable, but interest payable will be $100,000 times 8% interest rate times 2 over 12. And we're also changing discount on bonds payable. Okay, discount on bonds payable, here you see the discount $2,000. We spread it along 10 years. That's the same. We're only accounting for 2 months over 12 again. So what about the following year? What happens here? Would it still be March 31st? It would be April 30th, right? If we push back a month, April 30th, the account is still the same, interest payable, but this part would only be for November, December. This part, the purple box, the second one, will be for January, February, March, and April for 4 months. Okay, so cash part is the same. We're paying cash for 6 months. Discount on bonds payable, this part will change to 4. Because we're accounting for this next year, 2014, it'll be 4 months, January all the way to the end of April. Okay, I'm just saying that if I change the issuance date to November 1st, for this year, there will only be 2 months to account for, to accumulate interest on. Then for the following year, there will be 4 months before we actually pay the interest date. So the interest date will be paid, interest will be paid on April 30th. Okay, so just keep in mind the reason why we're doing this is because the cutoff point oftentimes at year end, companies do financial statements. We want to accumulate and make sure each and every account is being brought up to date. So that's what we're doing in the first entry. Second, we're reducing interest payable since we're paying cash interest for 6 months altogether. Okay, let's take a look at how these payables are reported on balance sheet. So I'm just going to show a table of financial statements. The liabilities section on balance sheet, assuming these are all the liabilities accounts, and I pointed out the ones that we actually talked about in Chapter 10, and here are the ones that we talked about in Chapter 11. Okay, so all of these falls under balance sheet, the liability section, and again, we usually separate the current liabilities from the long-term ones, and we usually list current liabilities first, then long-term liabilities. The difference between the two is having a lifetime less than a year or longer than a year. Okay. So the ones that I pointed out here are the ones that you need to know. Others in Chapter 10, payroll section, the ones that you're not familiar with, that I didn't mention in class, you don't have to worry about those sections. Okay, so for current liabilities in Chapter 10, we talked about accounts payable, interest payable on short-term notes, sales tax payable. We talked about unearned service revenue. Remember, collecting money first and then providing service. At the time point when we collect the money, it's the liability. Estimated warranty payable is part of contingent liability, the possible liabilities that will likely occur. Short-term notes, and there's also current portion of mortgage payable, current portion of long-term notes. The part that we pay by installments when it comes to next year, if it's due, this year it's considered short-term. Okay, long-term notes, as opposed to short-term notes, it has a longer lifetime, more than a year. There's also mortgage payable, usually it also lasts for more than a year. And we pay little by little, interest expense, principal amount, every single month. Now, bonds payable, the topic that we have been covering since last Wednesday, bonds payable, don't forget that whenever we report it, it's either reported like this at a net of discount or net of premium, meaning this is the carrying amount, or it's reported as the table that I showed you earlier, bonds payable, and then either less discount. You have a summary dollar amount here, which is this, $96,919. It's either reported like this, 2 lines, or like this, net of discount. But either way, carrying amount would always be shown. Okay, so it's not just the face value of the bond, it's also the discount portion, or the premium portion is always stated at the same time in balance sheet. Okay, if it's issued at a par, then basically you don't have this. If it's issued at the face value exactly, it would just be bonds payable and $100,000. But if you see a dollar amount different from $100,000, that basically means the bond was issued at either discount or premium. And you will find the discount or premium dollar amount in the middle of balance sheet. Okay, let's work on a few problems before we end the chapter. Let's say the company's bonds payable carry a stated interest rate of 5%, market interest rate is 7%, and what would be the answer to this question? Market interest rate is higher than the company's interest rate that they're offering. So the result of this bond issuance would be market interest rate is higher, company's interest rate is lower. So company is at an advantage or disadvantage? If it's the same, it will be issuing at the par value. If it's different and market interest rate is higher, meaning bondholder, if you are a bondholder, you're expecting more than what the company is offering. So if that, in this case, if you're borrowing money to the company, you'll be borrowing more money to them or less money to them? It will be less. So then in this case, it will be a discount. Okay, market interest rate, if it's higher, that basically represents the creditor's expectation. They're expecting more from the company, the interest rate. The company is giving less, so basically it's a discount. Okay, if the case flips, if market interest rate is 5%, stated interest rate is 7%, then that means company is offering higher interest rate compared to what market is anticipating. So in that case, it will be a premium. Okay, but this one here is a discount. If it's the same, then there will be issuing exactly at the face value. So if it was $100,000, it will be at $100,000. A discount means that the company is only able to borrow less money than $100,000. Okay. Okay, next one here. Let's say, well, the problem didn't tell you the maturity value. So if it's 500,000, then it's 500,000. Okay. So your Michael's trial balance shows 200,000 face value. This is the maturity value, the par value for the bond, and it tells you with a discount balance of $2,000. Let's say the bond matures in 10 years. How will the bonds be presented on balance sheets? So which one looks like the answer here? A? Any other answers? If A's the answer, what's wrong with B? There's got to be something wrong with B, right? Discount is actually the part that's correct. If you keep on reading the problem. Contra account, it is a contra account because it has opposite direction, right? Adjunct account is the one that has the same direction. So the problem for B actually is the term current liability. Remember, this entire chapter is about long-term liability, And discount on bonds payable is an account that stays there as long as the bonds payable's lifetime. So both of these accounts are actually long-term liability accounts. So the problem for B is that the discount on bonds payable is still listed under long-term liability section. If it's a short-term liability, that account completely would disappear after a year, but that would not be the case for bonds payable accounts. Okay, all of the bonds categories, basically, they're typically longer than 3 years or 5 years or even more than that. Okay, so both of the accounts are long-term accounts. Now, bonds payable, $200,000 will be listed as a long-term liability only. This part for C, it's missing the discount on bonds payable. Okay, D, bonds payable, $200,000 will be listed as a long-term, $2,000 will be listed as current. So this part again is the current part that's wrong. Okay, so the answer is A. It will be bonds payable at a net amount, subtract $2,000 of discount. Last question here. Let's say this company has $700,000 of bonds payable, 20 years lifetime outstanding. We need to issue the bond. These bonds had a discount of $56,000 at issuance. So it tells you the discount amount is $56,000 at the time when they issue the bond. That basically is the amount that they did not get while they issued this $700,000 of bond. And this happened 10 years ago. If the company uses straight line amortization method, that basically is the method that we have been using in class, then the carrying amount of these bonds payable after 10 years, what's the carrying amount of the bond? So for this problem, at the time point when the company issued the bond, what is the carrying amount at that time? You know, face value is $700,000, you know, the discount. So at that time, the carrying amount would be, it'll be $700,000 subtract the $56,000, right? So what is this amount here? It would be $644,000. So this is the carrying amount at the time of issuance. So what we want to know now is after 10 years of paying interest, amortizing discounts, what is the dollar amount 10 years later? The carrying amount of the bond 10 years later. So first of all, what will be the direction? Is the carrying amount gradually increasing or decreasing? Not sure. So the carrying amount at the time point is here. It was issued at a discount. Gradually speaking, it will increase to a point that matches with this. Okay, if it's a premium, it will be a dollar amount, something like $750,000 as an example. Gradually speaking, carrying amount for premium will be reducing to a point that reaches carrying amount, the face value of the bond. So if it's a discount case, gradually carrying amount will increase. So you know for sure 10 years later it will be a dollar amount higher than $644,000. But now we need to know what is exactly the dollar amount. So the discount part here, remember this part we gradually amortize it along the years. So $56,000, if we divide it by the lifetime 20 years of the bond, that will give you a yearly amortization. Then you use this times 10 years. That will give you over 10 years what you increase to the bond's carrying amount. Okay, so first step, calculate what was the original carrying amount, $644,000. Then you calculate on a yearly basis what is the part of the discount that you spread, that you add to the bond's value. So that will be $2,800, meaning every single year, $2,800 of discount will be reduced. So carrying amount will be gradually increasing to a point that gets closer to the face value of the bond. So after 10 years, bond's face value will be bond's carrying amount will increase to additional $28,000 more. You just add that to the original carrying amount. The reason why this is because remember every half a year we journalize interest expense entry. So every half a year we gradually reduce this discount on bonds payable while we journalize the interest entry. Remember we pay cash interest and then a little bit of discount on bonds payable will be amortized every half a year. So this part here tells you every single year, meaning if we times twice of what we journalize every half a year, that will look like this. $2,800 will be reduced from discount on bonds payable account, and at the same time this deduction increases bonds payable by $2,800. Okay, so little by little bonds carrying amount will gradually increase, and after 10 years it will reach this point. After another 10 years it would reach the face value of $700,000. Okay, so this part here, if you add another $28,000, that basically will give you $700,000 because the lifetime of a bond is 20 years. So this is the part that increases 10 years, and another 10 years you just add another $28,000 and that will give you the face value. That's the time when the bond matures. Okay, questions? I'm going to move on to the following chapter on equity. The following two chapters is on chapter 12 and 13 will be on corporations, paid-in capital. We're going to discuss a lot about how to take care of stock issuance, different types of stock issuance, and also if a company buy back the stock, how do we take care of those on balance sheet and journal entries. Okay, so chapter 12 is on paid-in capital and how it's reported on balance sheet. We're also going to touch a little bit on retained earnings again, basically reviewing the closing entries part. Okay, so this part here, the goal is to get to the dollar amounts that will be shown under equity section of balance sheet. We talked about assets in chapter 8 and 9. We talked about liabilities in chapter 10 and 11. 12 and 13 is all about equity section. Okay, equity, remember the general definition is the net worth of the business because assets minus liability will give you this section, equity. Equity, generally speaking, breaks down to two sections. We have the regular sales entry or service revenue entries. Later on, whatever you earn as revenue will factor into retained earnings account. So remember that at the end of each and every cycle, we always close revenue, close expenses, and update retained earnings by the sales revenue or service revenue the company earns. So this part, retained earnings, reports the internally generated capital based on the goods that the company provides to customer, based on the services that they provide to their clients. Now, the other section that we haven't talked a lot about, and we'll be introducing a lot in these two chapters, is paid-in capital. Okay, paid-in capital is, the idea is the opposite of retained earnings. Retained earnings is internally generated revenue. Paid-in capital is based on the fund that you actually receive from the public by issuing stock. Okay, typically not providing any type of service or sales, but just by issuing stock. This is a characteristic and attributes of public traded companies. This is a way for them to gain capital. Okay, so by issuing stock, paid-in capital reports all the money that was not internally generated, but the fund is basically received from stockholders in general, the public. Okay, so paid-in capital amounts is also there to finance activities for the business. This is a way for corporations to gain capital. So borrowing money is one way. In Chapter 10 and 11, we can borrow money from creditors, from the bank. We can also issue stock to the public by receiving fund from the general shareholders, the public. Okay, so if you and I, if we purchase a share from Amazon or from, let's say, Walmart, ShopRite, we are shareholders for that company. We're basically, in a way, we are owners of that company, one of the many owners. Okay, now in balance sheets, in company's balance sheet, it will show how many stock they issued and what is the dollar amount that they collect from the public. So this is an example of without issuing any stock, without performing any type of activities. In the beginning, the balance sheet would look like this, the equity section. But later on, you will see dollar amount added to this part. Once you start providing sales, services to customer, you'll have retained earnings generated if there's net income. Once you start issuing stock to the public, paid-in capital will also change. Okay, but the two main sources of equity comes from internally generated revenue, which will fall into retained earnings, and externally generated fund from issuing stock, which will go into paid-in capital section. Okay, so equity breaks down to these two parts. Then paid-in capital, we'll talk about different types of stock, common stock, preferred stock. When you see the term stock, shares, shareholders, stockholders, these are referring to the same thing. Okay, in chapter 1 through 4, we talked a little bit about corporation characteristics. Actually, we have a whole section talking about corporation characteristics, how it's different from proprietorship, partnership. So when you read this chapter, if you forget that section, make sure to just review the general characteristics of corporations. Okay, keep in mind that throughout the entire semester, what we have been learning so far is how to do accounting for a corporation type of business. Okay, not for proprietorship, not for partnership. For the company that is generally, that is public traded, they're able to receive fund from the public. They're able to issue stock, get fund from the public. Okay, so in the beginning, when any company starts incorporated, they have to file the articles of incorporation with the state, and then the state will authorize the number of stocks, the classes of stock that the company is able to issue to the public. Okay, so authorization of stock, this part basically, in each and every problem, you'll be given what is the number of stock that the company is able to, what is the maximum number of stock that the company is able to issue to the public. But then they will decide when to issue a little bit every single year. They can issue a lot in the beginning, or they can split it to issue a little bit every single year. So that depends. But there's a maximum level. That's the authorized number of shares. Okay, capital stock, again, just like I mentioned earlier, that it's the same as paid-in capital. It represents the number of shares and the value of the fund that a company receives from the public. That's capital stock. A source document for stock, there's also stock certificate. Nowadays, a lot of the times it's electronically formed. There's a company name on it, your name on it, shareholder, and also the dollar amount that you contributed to the company. So the number of shares owned. Once a person purchases shares, regardless of how many shares, they're considered one of the many owners for that company. Okay, shareholders are really the owners for corporations. But there could be hundreds and thousands of them. But as long as let's say you purchase one share from a company, you're considered one of the shareholders, one of the owners of the business. Okay, now the term outstanding stock represents the shares that company issued to the public. Remember, there's an authorized number of shares. Let's say the authorized number is 1,000 shares that company could issue, for example. Usually it's a lot more than this. If they decide to issue this year 100, then the 100 is the part outstanding. Even though they're authorized to issue 1,000, they may just issue a portion of that this year. So the portion that's actually issued out is considered outstanding stock. Now usually the term issued stock and outstanding stock is equivalent terms, but in Chapter 13 we'll talk about stock repurchase. And in that case, if company repurchased some of the stock that they issued before, then these terms will now no longer be the same. Okay, issued stock usually would represent the total amount of shares that company issued to the public, the fund that they receive from the public. This part here will represent also the part that they collect back. Okay, so just some of the terminologies you have to, when you review the chapter, make sure you understand each and every what it exactly means, just to help you understand the problems. Some of them we'll go over in more details in Chapter 13, okay, especially the repurchase part. Okay, now generally speaking, there's different types of stock. We have common stock and preferred stock. Okay, the company, when they started the state, would also authorize how many shares of common stock they're able to issue to the public, how many shares of preferred stock they're able to issue to the public. Just by the term preferred, it basically means that preferred stock, preferred shareholders has some of the rights, some of the advantages over common stock. Usually common stock is the majority part of where the fund comes from, but sometimes companies also issue preferred stock. However, preferred shareholders, they have a certain benefit that company will be providing to them. So for example, remember that we talked about dividends in the first 4 chapters a little bit. Dividends, you can think of it as gifts that a company gives to shareholders as a reward for thanking them to provide capital to the company. But dividends, company can decide whether or not to declare to the public. If they do decide to give out dividends, then if they have different types of shareholders, they would always consider it and give out to preferred shareholders first. So preferred shareholders will always get their part first, and then whatever is left is equally divided to common shareholders. Okay, so this is one of the rights they have over common shareholders. They receive dividends before common shareholders. And then other rights, voting rights, liquidation, preemption rights. Generally speaking, if the shareholders, as long as they own one share, they have one vote to some of the issues during shareholders meeting and annual meeting. So they have a right also to provide their opinion on some of the issues, corporate issues, as long as it's brought up to the annual meeting. If you have 1 share or 2 shares, the more shares you have, the more voting rights you have. Okay, dividends is a proportionate part of the dividends declared, so if preferred shareholders, they would always be receiving their part first. The remaining will be calculated to common shareholders. So we'll go into a lot of the cases later on in terms of journal entries, how we take care of these in corporation's perspective. Liquidation rights. Shareholders, they have the right to receive a portion of the assets once the company goes out of business. Now in terms of what part goes into what types of shareholders, always preferred shareholders has the right to receive their part first. Once their right is considered, then we consider common shareholders. Okay, now preemption rights is just a right that shareholders can remain the same proportion of the shares. So for example, if Amazon issues 100 shares and I own 1 share right now, if they decide to issue another 100 shares next year, I have the right to purchase again 1 share of that 100 shares so that I can remain the same proportion of the percentages of the shares that I have over the total number of shares that the company issued. Okay, so these are some of the basic rights for shareholders. You just have to have a general understanding and understand that you don't have to really memorize them all. Just have to know that in the basic sense what these different types of stocks comes with, the different rights. And also preferred shareholders, keep in mind that it has some of the advantage over common shareholders. Okay, while we go over this chapter, you will have a better understanding when we look into the journal entries. Okay, now some of the later chapters when we talk about issuance of stock, just keep in mind that stock, just like short-term notes, long-term notes, oftentimes there's also a face value, a par value of the share. So this is an arbitrary amount that the company assigns to the shares. There's no unified number that which dollar amount they assign to their shares. But some of the states that require a par value, some of the states they don't. So some companies do have a face value of the stock, some companies do not. So we'll be looking into some of the cases here in details with a face value, with a par value, without a par value, or sometimes company has a stated value of the stock. So just think of this as very similar to short-term notes, long-term notes. What's the original, or like bonds certificates principal amount. So this is like the principal amount of stock, the face value of it. Okay, so when we do have face value, we will be comparing what the company actually receives with the face value, and if there's difference, this is considered paid in capital in excess of par value or face value. Okay, the purpose of this later on when we journalize entry, the reason why we're talking about this is because when we journalize the entry on this, if a dollar amount that Amazon receives, let's say for a share is $5, and if their face value is $1, then the difference, the $4, would be considered paid in capital in excess of par. We have a separate account to account for the dollar amount differences between face value and the market value.